The gap between the 5% and the 95% is rarely knowledge. It is restraint, it is patience. It is the willingness to do simple things consistently while others chase stimulation. At the core of minimalist money is one non-negotiable principle: always spend less than you make. Not occasionally, not when convenient, always. This sounds obvious, but most people violate it in subtle ways. Income rises and spending rises with it. A raise becomes a larger apartment, a bonus becomes a new car, lifestyle expands to absorb every dollar available. The 5% resist this reflex. When income increases, savings increase first. Lifestyle changes come slowly, if at all. They protect the gap between what they earn and what they spend because that gap is the engine of wealth. Without it, nothing else matters. They also remove emotion from the basics. Savings and investing are automated. Money moves to retirement accounts and investment funds the moment income arrives. They do not rely on willpower at the end of the month. They build systems that make good decisions the default. The 95% try to save what remains after spending. The 5% invest first and live on the remainder. That one reversal changes the trajectory of an entire financial life. Another rule they treat seriously is the avoidance of high-interest consumer debt. Debt that compounds against you is the opposite of investing. It quietly drains future income. Minimalist wealth builders may use credit strategically, but they do not carry balances to fund lifestyle upgrades. If they cannot pay for something without stretching themselves thin, they wait. They understand that financial freedom and chronic payments do not coexist well. Minimalist money is not about deprivation, it is about selectivity. Instead of buying many cheap items that break or go out of style, they buy fewer, higher quality things that last. They think in terms of total lifetime cost rather than the lowest upfront price. A durable pair of shoes worn for years costs less than replacing inexpensive ones every few months. The same logic applies to furniture, tools, and technology. This mindset reduces clutter in both the home and the budget. When it comes to investing, the 5% often embrace simplicity. They are not constantly chasing hot stocks or reacting to headlines. They understand that markets move in cycles and that time is more powerful than timing. Many choose broad, diversified investments and hold them for decades. They avoid unnecessary trading, which reduces fees and emotional mistakes. Their portfolios are not exciting to talk about at dinner parties, but over long stretches of time they tend to grow steadily. Consistency beats drama. Minimalism is not only about cutting expenses, it is also about expanding earning power deliberately. The 5% invest in skills that increase their value in the marketplace. They negotiate salaries. They pursue opportunities that compound over time. Some build side businesses or acquire assets that generate income. The key difference is what happens next. When their income grows, their spending does not automatically follow. They widen the gap between earnings and expenses. That widening gap becomes invested capital, which produces more income, which widens the gap again. Compounding begins to work in their favor. They also prepare for disruption. Emergencies are not rare events, they are part of life. Job losses, medical bills, market downturns, and unexpected repairs happen eventually. The 5% maintain a cash buffer not because it earns impressive returns but because it prevents destructive decisions. With several months of expenses set aside, they do not need to rely on credit cards or sell investments at the worst possible time. Stability may not feel exciting, but it is powerful. One of the most overlooked minimalist rules is the rejection of status spending. Much of modern consumption is social. People upgrade cars, homes, and wardrobes to signal progress. The pressure to appear successful can be intense. The 5% understand that visible wealth and actual wealth are different things. They often drive practical cars long after they could afford luxury ones. They live in homes that suit their needs rather than impressing neighbors. They choose privacy over performance. By ignoring status games, they free enormous amounts of capital for investing. Instead of focusing only on income, they track net worth. Income feels good, but net worth reveals reality. Assets minus liabilities tell the real story. Someone can earn a high salary and still be financially fragile if debt and spending consume it. By reviewing net worth periodically, The 5% keep their attention on ownership and long-term growth rather than short-term cash flow. Another subtle habit is delaying major upgrades. When income jumps significantly, many people celebrate with larger fixed commitments, bigger mortgages, higher car payments, expanded lifestyles. The 5% often wait. They allow the new income level to run for a year or two while maintaining previous expenses. During that period, savings and investments accelerate dramatically. A few years of disciplined investing at a higher income can permanently change long-term outcomes. Impulse upgrades erase that advantage. They are also cautious about fixed costs. High recurring expenses reduce flexibility. Large mortgages, expensive car leases, and layered subscriptions lock people into constant earning pressure. The 5% prefer manageable commitments. Lower fixed costs provide room to change jobs, start businesses, or withstand downturns without panic. Flexibility is a form of wealth that does not show up on social media but proves invaluable in uncertain times. Over time, many in the 5% begin to see money as stored time. Every purchase represents hours of life exchange. Before buying, they ask whether the item justifies that exchange. Will it meaningfully improve daily life, or is it a short emotional lift? This simple question filters out impulsive decisions. It aligns spending with values rather than moods. Their overall approach to money can be described in one word: boring. They prefer steady progress to thrilling wins. They are not drawn to speculative bets that promise rapid gains. If an opportunity sounds too good or too urgent, they step back. Slow, predictable growth compounded over decades outperforms erratic swings driven by emotion. Boring builds wealth quietly. They do not constantly tweak their financial plans either. Once or twice a year, they review investments, insurance coverage, savings rates, and major expenses. Adjustments are deliberate. They do not react to every market headline or economic prediction. By zooming out, they avoid the stress and mistakes that come from overreaction. Perhaps the most important minimalist rule is defining what enough means. Without a clear definition, ambition can become endless consumption. The 5% decide what kind of life they actually want. Where do they want to live? How do they want to spend their time? What level of comfort feels sufficient? Once they clarify this, they build toward it intentionally. They do not chase upgrades simply because peers do. Clarity reduces unnecessary spending and sharpens long-term focus. So why do most people ignore these principles? Because they are not dramatic. They require delayed gratification. They require saying no when others say yes. They require living below one's means in a culture that celebrates visible abundance. It is easier to believe wealth requires a breakthrough than to accept it requires restraint repeated daily. Yet behavior scales. A consistent gap between income and expenses, invested regularly over decades, compounds into substantial assets. The math is straightforward, the discipline is not. The 5% understand that financial freedom is less about earning extraordinary returns and more about controlling ordinary habits. Minimalist money rules do not make someone look rich quickly. In fact, they may look average for years, but beneath the surface, assets grow. Options expand, stress declines. The reward is not applause, it is control over time. Control over career decisions, control over unexpected events. The path is not complex: create margin, automate investing. Eliminate high-interest debt, keep fixed costs manageable. Increase income deliberately, ignore status pressure, review progress calmly, define enough. None of these steps are secret, none require genius. They require consistency and a willingness to prioritize long-term freedom over short-term display. In the end, minimalist money is not about restriction, it is about alignment. Spending aligns with values. Investing aligns with future goals. Income growth aligns with opportunity rather than ego. The 95% often chase more. The 5% build margin, and margin, compounded quietly over time, changes everything. If this video challenged the way you think about money, that's the point. We don't need more complexity, we need better habits. The real difference between the 5% and the 95% isn't secret investments or lucky breaks. It's discipline, patience, and the willingness to live below your means long enough for compounding to do its job. And don't forget to like, subscribe, and turn on notifications so you don't miss the next video. We're building smarter habits here, one step at a time. See you in the next one.